And welcome to another Lumi Financial Corner. With us once again, Michael Zaremski, head of U.S. Private Banking, Bank Lumi USA, member of the Investment Committee for Lumi Investment Services. Michael, good to speak with you again. How are you?
Doing well, Zev. Good to speak with you as well.
Good to speak with you as well. Everybody's talking about the war in Ukraine. How is that affecting the work that you do, the financial markets?
Well, Zev, first off, let me just start the conversation as usual by saying the views that I will express today are mine and not necessarily those of the bank or the broker-dealer. And as it relates to the war in Ukraine and the Russian invasion, again, I think it's a very difficult situation, obviously human tragedy. And as we all watch the news reports come out of it, our heart is with the Ukrainian people. But the topic is Lumi Financial Corner, and I think it's important that we kind of focus on the financial aspects of it. And while certainly our heart goes out to all the tragic events that are happening in that area, the reality of it is the main drivers of what happens in the financial world and the economics here in the United States are still much more driven by local issues, while there is this big backdrop of, first time that there's actual war in Europe since World War II, or at least in that part of Europe. So with that, I think it's important to kind of highlight a couple of key points. When we do look at Russia, Russia is about 2% of the global GDP. To put that into perspective, the Russian GDP is somewhere in size between New York and Florida, significantly behind that of California and Texas. So if Russia was a state of the United States, despite all their size and their global importance, it would be the fourth largest state in the Union in terms of GDP. And a significant portion of that GDP is really tied to the energy industry as well as some other commodities. So that's really the main impact in terms of other cross-border or banking issues. Again, Russia has been a small player of that and not really that relevant to most elements of the financial markets at this point in time. Clearly, we will continue to observe that, pay attention to that, and see if there's any changes. But from this current situation, mostly what we're focused on is some of the elements of the energy markets. I will also add that the current situation clearly creates another element of uncertainty to an equation. And we've talked a lot about how uncertainty leads to volatility and why the markets are gyrating so much on a daily basis in terms of the up and down. And again, a lot of that is because of changes in expectations, uncertainty, and again, some of that is tied to the Ukraine conflict. But that does lead me to quote two iconic investors of our time. One of my favorite quotes from Warren Buffett is always be fearful when others are greedy and be greedy when others are fearful. Clearly, there's quite a bit of fear in the marketplace right now. So the question is, where can we be greedy, so to speak? Where can we take opportunity? And that really ties into another quote that I love from Jim Cramer, which is that there's always a bull market someplace. And the goal isn't to be fearful. It's to try to find out where we see opportunity, where we see that bull market. And when we look at the current environment in the United States, a couple of things that I think just really need to be reiterated. The economic data just continues to come out very strong and very healthy. We had a payrolls number this morning that not only was surprisingly strong, but there was a revision to the prior month's numbers that were significantly upgraded. We've talked a bit in the last few months about a lot of the noise in the numbers. And again, this is just another example of the noise in the numbers. And had the revisions not needed to be made because data was accurately reported the first time, again, we would have had less volatility in the numbers. But again, strong economic data, strong corporate earnings. Corporate earnings continue to come in very healthy. And those are really positive signs. What I'd also highlight to everybody, again, just a reminder, and it's kind of been overshadowed given the events in Europe right now, but there is a very strong movement of the lifting of COVID restrictions all across the country, whether it's state level, federal level, different mandates, really starting to see some changes, and that's really impacting recovery and reopening. In fact, in the economic data that we saw come out today with payrolls, the biggest surge in employment data has been leisure and hospitality, which is the part of the market that really needs to come back, as that's the part that's been hit the most. And that really all ties into the consumer strength. The other thing that we're seeing, Zev, is for the first time in quite some time, we're starting to see some of the supply chain issues easing. And I think that the real challenge for policymakers is this determination of, what is inflation? And inflation historically has been defined as a monetary event. And I think what we're finding out now is that the inflation we're seeing now is much more tied to demand. So it's really supply chain. It's not having enough supply to meet the demand. And it's been more of a fiscal issue. But for the first time in a while, we're starting to see some of that easing. And the Target CEO made some comments yesterday about being able to restock shelves more quickly, having better inventory. And that was something that we're starting to see more broadly across a lot of the retail segments. We're also starting to see car prices stabilizing a little bit. I actually keep track of some cars on Carvana. And interestingly enough, my anecdotal story is in the last couple of days, I've gotten a few quotes in where it said a car price was reduced. So again, I think that's anecdotal, but it just does point to the fact that you are starting to see some stabilization. And then the other couple of points that I think are important to note, for the last few months or so, all we've heard about is how expensive the equity markets are, and everybody was talking about needing a pullback to get back engaged. And if you look at tech companies in particular, if you were afraid of technology investing, a few months back, well, technology is significantly cheaper today than it was a few months back. And if you were looking for an entry point, this recent correction or pullback really may have given people an opportunity to make that reassessment and step back in. Again, we need to be selective about where we go into it. But again, prices have dropped meaningfully in the equity markets, and there could be good opportunities, again, given the strength that I've talked about. And the last element of the market, which again, I think is largely related to the Russian issue, is the energy markets. And we've seen a surge in energy prices. Again, oil has gone up over $100 a barrel for the first time in quite some time. And we're also starting to see gas prices creep up rather quickly. Expectations are that we'll be over $4 a barrel relatively soon. So again, that changes some of the dynamics that we're seeing in terms of what will the inflation data look like? What will gas prices do for household spending on other items? And how does that play into some of the Fed decision-making process? And we are expecting to get a 25 basis point hike by the Fed in March. There's been a lot of discussion over the last few months of whether it would be 0, 25, or 50. And with some of the comments that we're seeing now, we seem to be narrowing on the 25. And we're starting to see some of that impact in terms of bond markets are reacting to that. And I'll pause there and see if you have any other follow-up questions.
No, listen, it's, you said everything changes, are volatile, but with COVID restrictions ending and with war in Ukraine not having a major impact, I think there's room for optimism.
Yeah, and Zev, I think the key issue is that markets are always forward-looking, and typically they're going to be discounting what's going to happen in the market in the next, call it 3 to 6 months. So again, when we start to look through a lot of the short-term issues and we look out into the longer picture, again, the biggest macro trends that we can see and the biggest investable themes that we can see is that balance sheet for consumers, balance sheet for corporate entities are healthy. That should continue to fuel economic activity and economic growth. And that should give the Fed ample room to start to try to normalize policy. What I do think we are seeing right now is that some of the events that are happening, again, higher oil prices and other elements that may naturally slow down the economy, that may take pressure off the Fed. So some of the prognostications of maybe 9 hikes this year may start to get ratcheted in. And, I think that the central point of how many rate hikes we're going to see for this year continues to kind of hover in that 4 to 6 range, with most people kind of looking at the 4 or 5 as being the more likely. So as we continue to go through, we'll get a little bit more clarity of that. But again, what we're trying to focus on is where are the strongest macro themes. And again, so much of it goes back to strong consumers, recovery, reopening, and that's currently being supported by the economic data.
Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Thank you for being here with us.
Thank you very much, Zev, and look forward to speaking to you again soon.
And we're going to be right back. Don't go away. Stay tuned.